Get Rich Education is brought to you by Norada Real Estate and Highlands Residential Mortgage.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to GRE, Get Rich Education, episode 142. Hi, I'm your host, Keith Weinhold, back on track to provide you with another wealth-building week. This is the investing show that is simultaneously educational, actionable, and inspirational. Well, looking back here, the year was 2007, and I had just purchased my second fourplex building, going from 4 units up to 8 units, expanding the portfolio. I purchased it for $530,000, a $530K purchase with a monthly rent income of $5,200 from the 4 units, almost meeting the 1% rule there, and I was feeling pretty good about my new buy. Each townhouse-style unit had 2 stories, and everyone had their own garage, but soon things would turn bad. Now, I sure thought it was odd that before I got to the closing table on this deal, that the mortgage company that I thought I was going to close with suddenly went poof, gone, imploded. So after a delay in the closing, I ended up finishing up with a different mortgage company, and I was told that I was awfully fortunate to get that fourplex closed at all, because loans soon might not be available to anybody any longer. So I felt lucky to get my 10% down, non-owner occupied, 6 7/8% interest rate, interest only, with no mortgage insurance loan done at all. But after closing, I soon had an uneasy feeling that, well, geez, if no one can get loans anymore, first of all, I don't know what's going on here. And secondly, that is going to kill demand for real estate, and therefore kill the value of this building that I had just bought. And in fact, I would soon learn that there was a website called Implodometer.com that tracked all these banks across the U.S. that were quickly becoming insolvent. So what happened during this mortgage meltdown more than 10 years ago? The U.S. housing crisis, it is that speculators, basically including seemingly everyone in the U.S., was caught up in real estate investing mania. Everyday people had experienced rapid real estate value growth for years, some years even 40 to 50%, even 60% appreciation per annum in some markets, which felt so unsustainable. But yet most everybody was still of the belief that real estate values could never go down. Well, what had soon happened is that since banks were making irresponsible loans to borrowers with poor credit, well, soon when those riskier borrowers, called subprime borrowers, when they couldn't repay their loans, oftentimes when their adjustable rate mortgages reset higher, housing demand and faith eroded, banks imploded, almost no one could get loans, many people lost their homes, and later the U.S. government jumped in to bail out failing banks. So over the next 2 years, what had happened to my latest buy, this newest fourplex building, was that over that period of 2 years from about 2007 to 2009, my property had deflated in value from $530,000 down to $480K, about a 10% shave in value, and it was a pretty low feeling. It was a little bewildering as to what was happening as I learned about ever more and ever larger bank failures, and when the value of the property went from $530K down to $480, and it's at $480. At that point, I didn't know how much lower it was going to go either, and I didn't know that it was going to be the eventual bottom there. I just felt like it was going to sink lower, and as it turned out, people in a lot of other markets fared quite a bit worse than that. And, on the one hand, I was happy that a new buyer right next to me got a fourplex for $480 when I had to pay $530 2 years earlier, but I also remember at the time, it was pretty easy to feel like I had bought high. But soon after this, I started to notice something, okay? In both this newest fourplex building I got for $530 and the first fourplex building that I had bought 5 years prior, and I had only owned 8 rental units at this time. This was 10 years ago. Okay, not only was my occupancy seemingly always at 100% in my 8 units, but I was also able to ask more and more in rent amount. So despite the fact that my building had dropped in value from 530 to 480, I was cash flowing better than ever. And it was at about this time, 2009 or so, that I had an aha moment, an epiphany. And that was that it really didn't matter that my building had lost 10% of its value if people were paying me more than ever each month to live there. What had happened is because it was so difficult for people to qualify for loans to go buy their first place, and they couldn't do that any longer, well, that drove rental demand through the roof. They had to rent, and they had to rent from me. So now, because the mortgage market was impotent and failing, I was winning, and my epiphany was, wow, I win both ways. If my building would have appreciated, I would have been in good shape, but it wasn't. And the fact that it was going down in value due to seized up credit, well, that meant that my income from the building kept hitting new highs. People had to rent from me. So the temporary loss in building value didn't matter. It rebounded. And how much would I want to sell something that's paying me better than ever to hold on to it? It really doesn't matter that much that it lost value in the interim. That's because I bought the building for cash flow in the first place. I bought for the right reason in the first place. It provided cash flow from day one, and then it just cash flowed more when those wannabe borrowers had to rent from me rather than buy. So having lived through that experience, which was harrowing for so many people, cash flow saved me. And I know that you might think I'm conservative when today I tell you to only buy properties that cash flow from day one. Well, even that's not enough. You have to buy properties that cash flow from day one, and they need to be in geographic markets that are creating jobs so that your cash flow is durable and you have not just a rent-paying tenant on the day that you buy the property, but also a reasonable expectation that there is going to be a second tenant in line down the road to move into your property when your existing tenant moves out. Now, several weeks ago, we had Rod Khalifa on the show. Both Rod and today's guest, I think, have some similarities to their stories. Okay, back in the day, 10 plus years ago, they were buying properties all over the U.S., and they were doing a lot of speculation rather than investing. That's because they weren't paying attention to whether the property cash flowed or not. Back then, even people with 550 credit scores were grabbing single-family homes, apartments, condos, whatever, and just jamming them into their portfolios. And they could because the lending standards were so lax. Zero down payment, almost zero loan qualification documentation that they had to show. And they might even have gotten cash back at the closing table as they were just recklessly jamming properties into their portfolio. It's like they were playing Hungry Hungry Hippos, this game that was popular in the 1980s where kids used these plastic toy hippos and the object of the game was to gobble up as many marbles as quickly as they possibly could. Well, the same way, real estate speculators are just ravenously and sloppily gobbling up properties like they were playing Hungry Hungry Hippos.
And get the most marbles with your hippo, playing Hungry Hungry Hippos. Hungry Hungry Hippos.
Hungry Hungry Hippos is the name of the game, and whoever hippo gets the most marbles wins.
Playing Hungry Hungry Hippos. Hungry Hungry Hippos.
I win!
Hungry Hungry Hippos from Hasbro.
Yeah, it's like they were playing Hungry Hungry Hippos. It was crazy. People were buying properties speculatively without regard to fundamentals. When things blew up, these speculators hadn't invested for cash flow, and just as bad, both Rod and today's guest self-managed in multiple markets. You know how nuts that is? They managed these properties themselves in multiple far-flung geographic markets. So their portfolios were splintered and so fractured, and then they were depressed in value, plus they didn't cash flow. This was un-turnkey-like behavior. Many people did not calculate management into their ROI. And a lot of people still don't. At GRE, we calculate management in before we buy. That's how it's passive. I know it might sound conservative to you. I know you've heard it 10,000 times, but buy for cash flow in a sustainable market with a turnkey provider, just like we do at greturnkey.com. Well, let's talk about it with today's guest. He joins us from Sedona, Arizona. Today's guest is a financial transformation expert. You're going to find out what that is. His real estate investing career began almost 20 years ago when he bought his first rental income property by using a $6,000 cash advance off a Visa credit card. He went to every seminar he could find, and he did everything the coaches told him. In fact, he ended up spending over $1 million on seminars and mentors in his career. But yet, you know what? He still ended up almost declaring bankruptcy because he was doing the fun stuff back in the day, but he wasn't doing the right stuff. He flipped a switch. He did the work it took to be successful, and in the next 5 years, he built up a $20 million portfolio with 150 properties of houses and apartment buildings and condos. So by age 27, he had operations in 7 states, but he lost everything in the 2008 crash. He stuck with it. He rebuilt his investing career, and he went on to become a sort of genetic entrepreneur, having started and owned more than 35 different businesses. He also considers himself the world's most employable man. I want to ask him about that. Today, his role in the real estate investing industry is as a lender and a mentor with Total Control Financial, where he can live the lifestyle he wants while building his wealth and advising the investors he partners with. Welcome to Get Rich Education, Damian Lupo.
Keith, it's so fun to be here. I'm really excited to have this conversation with one of my local Alaskaites. You know, this is pretty unique that we have this conversation and can both talk about something that we're intimately knowledgeable about, the Anchorage, Alaska environment.
Damian's familiar with Anchorage, my longtime hometown. Damian was raised in nearby Eagle River, Alaska. I actually happen to own an apartment building there. It's maybe a quote-unquote suburb of Anchorage, so there aren't a whole lot of guests I get that really understand Anchorage.
Yeah, it's funny. We were talking before the show and about how people think that Alaska is northern exposure or it's all snowy all the time. And I tell people it's amazing. We have tons of sun for about 3 days in the summer when I was growing up. It was a lot of sun and then it was a lot of darkness, but it's a very unique, very cool place to live and especially to grow up. So it's cool that we can share that.
Yeah, it's a great city. It's a progressive city. We don't all get around on snowmobiles. But
no.
Damian, you're the one that has the interesting story. What I just read there in your bio sounds almost crazy. This just sounds like a guy that is going for it, going all out, maybe even going in almost every different direction. So as I read over that, I think that really begs a question, Damian, is how did you get the money for all these properties that I talked about in your bio there?
Well, Keith, the thing that I didn't really think about a whole lot was what I couldn't do. And I think that this is one of the values of doing things when you're 20 years old. And something we can tap into, whether we're 30, 40, 50, doesn't really make any difference. It's having that youthful naivety that, hey, you know what? No problem. I can build the Great Wall of China. I mean, of course I can. It's just not knowing what you can't do. And so back when I was starting in my early 20s, I just figured, hey, you know what? I can figure out where to get the money. I knew I wanted the outcome of having cash flow properties. I read Rich Dad, Poor Dad, and I thought, I don't want to be the guy sitting in a cubicle. I mean, that's not my life vision. And so I thought there's got to be a way to do this. And I went to a seminar in Florida and met Robert. And then when I bought that first house using a cash advance on my Visa, that seemed like a natural thing. I was utilizing resources, and we all have these resources. We've all got, whether it's a family member or a Visa card or some IRA money, or we've got resources. We just have to open our mind because the resources are in our mind. It's not in our bank account necessarily. And that's the thing. We've got to be more creative and more open to the alternative stuff, because if we listen to traditional or mainstream marketing, which is really what all that stuff is that comes from Wall Street or really our neighbors or traditional sources, we're going to be stuck in a traditional lifestyle. And for most people, that's not really what they want.
Yeah, sometimes naivete can be bad because fear gets injected into it and you realize what you don't know. But sometimes naivete can be a good thing because no one's told you what you can't do yet. So how did you actually find all these properties? I mean, did you use something like the MLS when you were building up this portfolio at a crazy rate back in the day? Or were you using Craigslist or bandit signs that say like we buy houses on them that were around? Or how did you find all these?
You know, Keith, it's funny because I did the things that are still really that work today, that really work. And that is I got outside my house. I got out from behind my computer and I was in the streets. I was literally looking for deals that jumped out at me that weren't being marketed. I was putting flyers on houses. I was using bandit signs. I wasn't looking at the MLS because quite honestly, the MLS is full of properties that everybody in the world can see now. The internet has brought everybody to the same place and you have to do something different, which means you really got to hustle. I like what Grant Cardone says when he talks about hustling. That's where the money is. It's in the hustle. I was doing things. I was marketing. I had yellow pages, ads. I had things where I had to take a risk. I had to either go out in my car and drive around. I had to spend some money. I had to try things and there was no guarantee. what I think a lot of people do is they look for a guarantee. They look for an MLS property where it's all pretty and all the description and the yields and everything else are in this listing. And the problem is you're fighting with everybody else, and you want to find the space where you're not fighting with everybody else. And that's where the deals are. And that's where I ended up spending all my time.
I like to say that, well, I think at least for me, I've lived long enough now that when I look back, I think the best parts of life and a life well lived is kind of living a life where you have these big highs and where you subject yourself to big lows as well. It's where life isn't just exactly the same every day. And if that's one definition of living life, you sure have lived a life already. So with all this experience and all this kind of both success and failure, so today there's just a million options and endless information online. So with that in mind, in your experience, where do you think is the best place for people to start today? And in a way, Damien, this is asking, like, if you could do it all over again, what would you do? Or if you were starting today, what would you do?
It's funny you asked that, because one of the first things I did, and I think it was about the 4th year that I was in my real estate investing career, and at that point I probably had, I'm guessing, about 100 houses. I wrote a book called Maverick Mistakes in Real Estate Investing. I don't recommend you look for the book because it's the worst cover you'll ever see, and you'll think, oh, this guy's an idiot. And it's because I designed this cover on my PowerPoint. So it's a terrible book, the worst you'll ever see. But what I did is I documented all the things, all the mistakes, at least what I could remember. And it was $1 million worth of mistakes right then. One of the chapters that jumps out immediately when you ask the question about what would I do different is I would have focused in a very small area. I would find like a 10 square mile area and I would dominate it. I would become the most knowledgeable person in that chunk of space. And I would just go in and I would create wealth there. The truth is you can create millions or even billions. I mean, truly, you can create any wealth number you want in your local area. And I think a lot of people make the mistake of wanting to go all over the place. Even when I was in Phoenix, I was investing all over the Phoenix Valley. And if you know Phoenix, it's enormous. It's a massive 3-hour corner to corner type of drive. And I had houses everywhere. So I could easily spend an entire day driving between 2 houses. That's a stupid plan because you waste so much time. And that's the one thing that you have that everybody else has the exact same amount of, which is time. And so if you squander it, you're really screwing yourself. So I would say the first thing is figure out which area you're going to go after, and then geographically stay in that space and find a way to punt on everything else. Because there's something I heard, I think Warren Buffett said it, the difference between successful people and highly successful people is highly successful people say no to almost everything. I wasn't willing to say no to anything. So I was all over the place, in Arizona, all over Phoenix. I was in Tucson. I was in Alabama, California, Oregon. I mean, I was everywhere. I did deals in Alaska. I was splintered and fractured. That is a massive mistake that people make because they're not willing to just narrow in and focus. And when you focus, all sorts of magic happens. So I would start with that one. Go into your backyard and start tackling it based on becoming an expert in that area.
Okay, so you're kind of talking about getting rich in a niche, and it sounds like back in the day when you were spread across 7 different states, you weren't using like a turnkey provider where you had dedicated managers in different markets, and you were trying to kind of do a lot of it yourself, it sounds like.
Yeah, that's one of the things that I like about what you do and what things that you talk about with the turnkey stuff. If you've got the really great partners, which is really what you're doing, if you're doing a turnkey, you're finding great partners that are creating great opportunities. If you're in relationship with those type of people, then all of a sudden you've got options because you're truly creating some cash flow. You're creating some investments. You're not creating a job. And one of the mistakes I made was like I bought an apartment complex in Memphis, Tennessee next to Graceland, which you'd think would be cool because it was by Elvis's house, but it turned out to be a disaster. I mean, it was so bad. This is how bad it was. I had my security guard. He was killed on site protecting the property from people that were stealing copper out of it. This is how bad the neighborhood was.
Wow.
Yeah. And I was off site. I didn't have a partner that was there that knew what they were doing. So I would come out there every 2 or 4 weeks. And ultimately on that property, I lost a couple $1 million. It's because I wasn't in relationship with somebody that had integrity or even anybody that knew what they were doing. And so I was disconnected from my money. I was disconnected from the success or the failure or the problems. And I think that was a massive mistake that a lot of people can make if they don't do something that you've been talking about with the turnkey type of investment deals with the right people.
So it sounds like back in the day, and just to remind the listeners here, we're talking about the loss of an 8-figure portfolio, a $20 million portfolio with 150 properties before losing it all in 2008. So that makes me think of a few things. Number one, it sounded like, well, you were pretty sloppy back in the day. You were almost like playing Hungry, Hungry Hippos. You just want to take over every property you can get and build up your empire without a whole lot of regard to maybe the quality or the relationships. Or I'm going to guess the thing that wiped out a lot of people prior to 2008 is they were not accounting and they were not paying attention to cash flowing properties. Is that part of this?
Yeah, there's the laundry list of stupidity is massive. I mean, it's like a laundromat. It's so bad and so big. You mentioned something in the very beginning right there. You talked about going fast and the hungry, hungry hippo. I was on a tear. So speed kills and I was going super fast and I was harvesting the seeds. And that's one of the things, if we're talking about single family homes and creating wealth, we're talking about financial freedom, we're talking about cash flow that lasts. You have to make sure your cash flow is there and you're not eating it. Meaning I was taking the equity out of my houses in many cases, and then I was just eating it versus allowing the equity to sit. So my cash flow continued and I was becoming a really good hunter, but I was not a very good farmer. And a farmer is where you create the wealth and the freedom, where you've got these houses that are paying you, you've got your property that's paying you long term. If you just go harvest your equity, if you're borrowing out all the money all the time, or you're selling it off like I was to different investors, you don't really have anything that's sustainable. And so I was going so fast, living a big lifestyle with really shiny objects like Ferraris and everything. And that ultimately was not something that was going to last. So 2008 ate my lunch because of my habits, my behaviors, and my focus on just having this big lifestyle versus having a big portfolio that could last.
Yeah, now you mentioned harvesting your equity. Some call that equity stripping, or going ahead and once equity accumulates in a property, doing an equity transfer into another property. But when you do that, you still need to pay attention to cash flow. Now, I've actually often been an advocate for going ahead and doing cash out refinances because the return from equity is always zero, and part of it's based in that, but you need to go ahead and harvest that equity in a responsible way.
Yeah, you're right about that. There is a responsible way. I can tell you the not responsible way, and that is just selling it off or pulling it all out. So you start with a house. I mean, I did this way too many times where you start with the house that maybe is making you $300 a month and you've got $20,000 in equity. And either you refinance the thing and you pull all the equity out and now your cash flow at zero and you have $20,000 in cash, or maybe you sell it, that chunk of equity, you sell it to a partner. So the partner gives you $20,000 and you give the partner all your cash flow. So it feels really good because it's kind of like being a cokehead. You just have this hit, or a heroin addict. You just have this hit, this surge of cash, and it feels really fun. And you can do all these fun things, travel, and you feel like you're a badass because you've got this big bank account. And then you have a big pile of mess that you've got to manage. And you're thinking, this sucks because I'm not really making any money. And I've got all this work to do for the next 1,000 years. So you're talking about something that's smart, which is reorganizing and engineering your equity smartly and with intelligence, whereas I was doing it very recklessly. And that's one of the downfalls of being in your 20s. And stop listening to people that have been through things. You stop listening to mentors. You think that you're really smart and you know everything. You'll do dumb things like stripping out your equity in an unhealthy way.
It's easy to believe someone knows it all and that they know all they need to. Back in those days, 10 to 15 years ago, when you were just getting massive appreciation in so many of these markets, that could cover up a lot of mistakes. You could be forgiven for a lot of things with wild and rampant appreciation that you had there.
I think that that's actually that's happening right now with a lot of folks that they're not being intelligent about investing, and they're thinking that they're super smart because they caught this timing. And especially where I was living recently for the last 6-7 years in Austin, Texas, there's this huge boom. And I've seen a lot of people think that they're brilliant because their property they've doubled over the last 3-4 years. And they think, oh, I am so smart. I'm going to go do this. I'm going to make money. I sold my property. I've got $250,000 in cash. I'm going to go do it again. And I just laugh because it's exactly what I did in 2005 and 6, where I sold off a ton of properties, had all this cash. And I thought, oh, I am so smart. No, my timing was really good. I took action. But I didn't realize that, and I wasn't paying attention to market cycles. And really, we're in a space now where you've got to be intelligent about what you're doing. And if you're just speculating, you're going to get hammered. It's like going to the casino and riding an all red, and you think it's always going to be red. And all of a sudden it goes black and you keep doubling down. People are doing that in real estate now because they're not being intelligent about position sizing, like how much cash you have in each property, or demographically where you're spread out, diversified, how much cash you have that's dry. I call it dry powder. You've got to be smarter than being the dumb speculator that thinks everything always goes up.
Yeah, it's easy, again, to start feeling this psychological wealth effect when you have had appreciation in your portfolio. If you're invested in stocks, you've got great appreciation there. If you're invested in real estate, you probably got some really good appreciation there as well. So it's easy to get overconfident, but it sounds so old and overstated, but one can't say it enough. That deal needs to make sense on day one. Don't be a speculator. That means it needs to cash flow on day one. Well, Damien, I want to ask you about some other things because you're just a really interesting person. And I know with all this transactional experience you've had, you said that you will not do deals with guys that are in their 20s. So go ahead and expand on that.
Here's the thing that I remember back when I was first starting at the first seminar I went to in Orlando. I walked up to some guys that were doing hard money lending. And I said, hey, I'm a real estate investor. My name's Damien. And how do I work with you guys? And they smiled and they said, that's really great. Glad you're here. And after you've done 4 or 5 houses or deals or whatever, come back to us. And I thought, you guys are so stupid. You're missing out on working with me, because my ego was driving that ship. And what they realized, or what they knew, and what I would eventually realize, is that I didn't have any emotional intelligence. I was just ready to shoot from the hip and kill anything in sight and go for it. I didn't know about managing. I didn't understand any of the position sizing stuff. I didn't understand how to take a loss with intelligence. I mean, there's a way to say, okay, I made a mistake, write a check, move on. And then there's the stick your head in the sand and just pretend it's not there. And until you've gone through those things, and people in their 20s or even brand new, they're in their 50s, it doesn't make any difference. When you're new, you don't have that experience. And so it's hard for me as a partner or a hard money lender or anything to have any idea what you're going to do when things don't work, and they never work out exactly as you think. I'm careful about who I'm going to invest with. It's more important about who it is and their experience and their integrity, way more than what market they're in or how good the deal is. That's so secondary. It's not even funny, but people think it's all about the deal. It's not about the deal. It's about the people.
Yes, sometimes I talk about how the deal or the property itself is only the 4th most important thing. Number 1 is what matters to you as the investor. Number 2 is what's the vibrancy of the economic market that you're in. And then number 3, who are your partners, or who is the team, or who is your turnkey provider, and who are you dealing with? If any of those first 3 things don't work, the property or the deal doesn't matter. That's why it's only the 4th most important thing. Well, Damien, a crash brought you to your knees in 2008, and you're resilient. You've recovered since then. I know you think that we're going to have another crash. So with your hindsight and seeing what led up to the 2008 crash, which was basically irresponsible lending, I've heard you say that you virtually guarantee a crash in 2018. So tell us about that, and what can one do and why?
It's something that everybody needs to really pay attention to, that we are going to have a correction. It's going to be a crash. It's going to be painful. There's a high likelihood it's going to be worse than 2008. There is a definite certainty that it's going to happen. And when this happens, and here's why it's going to happen. When you have rates continuing to move in one direction, it pushes prices in a different direction, the opposite direction. So we've watched this happen the last 6-7 years, where rates have been super, super low. And this happened in the early 2000s, where rates kept dropping after 9/11. They were dropping, and houses kept going up. And rates have continued to be low, and 10-year treasuries have kind of chunked down. All these rates staying low creates an opportunity for prices to go up, because people and we're talking about houses in general, houses are based on people's ability to borrow and make payments. And if your job and income has basically been flat, if everybody's income is essentially the same over the last 5 years, how are prices of houses going up? It's because rates continue to bend down, or they continue to move down, and that allows people to buy more house. When rates go up, and eventually they will go up over another point over the next 12 to 18 months. This is what the Fed's scheduling. There's treasuries that kind of work with the Fed. And bottom line is, when rates go up, you're going to have an inverse effect on the prices of houses. So people that have been speculating, they're thinking my house is going to go up some more. Well, no, it's actually going to go down, because people can afford a similar payment. And that payment with a higher rate is going to mean they can buy less house. It's going to put downward pressure on housing, which means if you're speculating, you're setting yourself up to get hammered probably by 15 to 20% on the price of houses over the next 18 months in general across the board. Because when rates go from around 4 to around 5, we're talking a 25% increase. And a 25% increase in rates pushes pricing down about 18 to 20%. It's simple math, but people want to ignore it. They just think everything is great and the skies are blue. There's a storm coming, and you can make a ton of money in the storm. And that's one of the things that I missed out on in 2008, which is really kind of sad. When you blow yourself up, you tend to be so frozen because it hurts so bad, you're not able to actually engage. And so if you're setting yourself up now to get hammered when this thing comes, you're not going to be in the game when the opportunity is the greatest. And that's one of the things that I would encourage people to be cognizant of, is that when this opportunity comes, if you're able to be in the game, you can get absolutely rich, because most people are going to be frozen, paralyzed, and afraid.
Let's talk about geography for a second, because real estate is location, location, location. I just want to know if you think any geographies are more vulnerable than others. For example, on the coasts, we've already seen a little bit of evidence in New York and San Francisco that prices are not increasing, that you can't get any more for rents. What about people that are invested on the coasts versus people that are invested in the heartland with this coming crash?
Well, you have to ask yourself what's really supporting everything. And if you're talking about the coast, there's two things that are there. There's one, there's a lot of hysteria around places like San Francisco or places where there's a lot of tech. It's a lot of bubbly stuff, and it's really hard. The prices have just continued to move up, both prices and rents. And ultimately, that's not sustainable. When you have a correction, there's going to be give back there. The thing I like about coasts is that as people get older, they want to go towards the coast. They want to be in places that are sunny and that they're gentle, these climates. So I think that they're long-term going to be very, very stable, but not in a speculative nature. I think that's a very short-term play, and it's not something that I would be really optimistic about over the next couple of years, maybe over the next 15 or 20 years. I like the idea of having coastal property, assuming that the ocean doesn't end up taking it out, like in Miami, where you've got the ocean level rising a half inch a year. I mean, literally it's rising. So how long until Miami has a huge problem? 20, 25 years? Those type of things are something to be considerate of. But big picture, the trend I like to focus on the most is the millennial push. And the millennials, we're talking 80 million people. There's a certain type of housing that millennials want. And in general, and we're not talking about the edges of the bell curve, we're talking about the sweet spot in the middle. Where do they want? They want to be in spaces where they're connected to other people. They have experiences. They don't want giant houses. They're not looking for McMansions. That's a 2000s type of episode. That's a baby boomer thing. Big houses and big garages.
Yeah.
Millennials don't care. They don't even want to own a car. In fact, owning a car doesn't even make any sense when you've got Uber and things. So, or Lyft, or whatever is going to be in existence in 5 years. But the point is that millennials, if you're serving that group, and they're not being served very well right now, people that are focusing on creating housing are going to create a massive amount of wealth with a demographic that's young and that is going to be able to be served for the next 20, 30, 40 years in a really profitable way. And it's a niche that you can find anywhere. There's millennials from Anchorage to Austin. They're everywhere. They tend to want to be engaged in more urban areas. They don't want to typically be in the middle of nowhere because they want to connect. It's a digital Facebook group and they want to be around other people. So finding ways to serve them, it's different than the single family houses, but you can find single family housing opportunities by thinking about alternative platforms, things like Airbnb. You can make so much more money on Airbnb than you can just renting a house in the right area for a monthly. You do it on a daily rate. Those type of opportunities didn't exist when I started. Now, the amount of wealth that you can create by using those is epic. And so I would be thinking about the alternative space and not just what's worked 30 years ago.
Yeah, that's right. There sure are a world of opportunities today that weren't there a generation ago. Well, one thing you mentioned was hard money lending. So I want to come back and talk about hard money lending a bit, because once a borrower has gone ahead and exhausted their 10 Fannie Freddie loans, hard money is one option that's out there for them. You're listening to Get Rich Education. Our guest is Total Control Financial's Damian Lupo. More when we come back. I'm your host, Keith Weinhold.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
This is Cashflow Diaries Jay Massey. Do the right thing, then do things right. Listen to Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education with our guest, Total Control Financial's Damian Lupo. Just a really interesting person to talk to that has just gone all out in real estate investing at one point and is definitely a risk taker. And I think he's more of a measured risk taker today. Damian, I want to ask you a bit about hard money loans. We've talked about conventional financing here, and I'm just going to give the audience a little hard money lending 101. Just what is it and why might you use it? And then I just want you to clarify or add to that as you want to. Hard money loans are basically short-term loans, and they're funded by private investors. With conventional loans, they're funded by government-sponsored agencies. And with hard money loans, you often pay 2 to 4 discount points up front, and you often have to put more than 20% down on those loans, and you could pay interest rates of about 10% or more. So those are some reasons that you really only want to use those after you've exhausted your conventional financing options. Hard money lending, it got a bit of a bad name back 10 or more years ago. In prior years, we had some, I guess, predatory, I'll really call it, hard money lenders practicing what I'd call loan-to-own schemes. Okay, they'd make risky loans to borrowers. Those lenders would use real estate as collateral, and then they would try to foreclose on the property when the borrower defaulted because it was such a high-risk loan. So hard money lenders really got a bad name back then. What do you have to say about hard money lending today, Damien? Where do you see it working best for people?
I don't know that it's changed all that much in terms of there's really great hard money lenders, and then there's a lot of scumbags that are doing the loan to own. In fact, I remember experiencing that with my property in Tennessee with the lender that had actually owned that property, the apartment, years before. And so when I needed money, when my traditional bank lender bailed out like 2 weeks before I was supposed to close, this guy pops up and he said, "Hey, I'll loan you the money. I'll give you $1.2 million for your rehab." And I said, "Great." And I really wasn't paying attention to his intention or who he was. And this is why it comes back to the people, whether you're investing with somebody or you're borrowing from somebody, you want to know who you're working with. It's not just a spreadsheet. The deal looked good on the spreadsheet, but what I didn't realize, ultimately, this guy did foreclose on the project and he took it back. And then he filed a lawsuit to try to get a deficiency. And what that means is that he used the laws to try to squeeze more money out of me after I'd already lost all my equity. He wanted to try to make more money on the deal.
Gosh.
And he was so slimy. And I was so greedy that I went, "Oh, I'll do business with a slime ball." And now I wouldn't touch a slime ball. I don't care if he's offering to write me a check and says it's a gift. I won't do it. This is the thing that you've got to filter. You need to figure out who you're borrowing from and who you're lending to. And you had mentioned this a while ago with the things that we look at. And we talked about the deal being really the fourth most important. The first one, it's the people, and then it's the market. I mean, and so like when I'm doing hard money lending, I'm looking at the people involved and the team. Is it just somebody that's doing a part-time deal that's not really invested, or are they really engaged? And then are they doing it in a place that I like, that I feel comfortable with? If I had to take the thing back, if my team dies that I've loaned to, I want to know that I'm going to go there and be okay and not going to get killed in the process. I'm not going to do it in the middle of some bad part of Detroit. It's just not my thing. And I'm not going to invest in something that I don't want to invest in. And so like I've had deals where strip clubs were pitched to me. I don't invest in strip clubs, not something I'm interested in. And the cash flow is crazy. I mean, it's really, really good, but I'm not going to invest in that. So you've got to get narrowed down on what you're going to invest in if you're going to be a lender. And if you're going to be a borrower, you need to make sure you know what kind of deal your hard money lender is interested in. And you need to know the person. Who is that person? Are they somebody that's looking to loan just so they can own your deal? Or do they want to do deals with you over and over? I like doing deals with the same people over and over again.
Yeah.
And you'd mentioned something, Keith, about the percentage. Like you need to have 20, 30% of your own money in a deal. And that's true with hard money lenders up front. First deal, they want to see you with skin in the game. What's fun is I've got deals with people where once I've done a deal or two with them and I've watched them perform, I'll give them all the money for the purchase, for the rehab. They have no money out of pocket. It gives them the ability to go do lots of deals. And there's ultimate leverage where you've got an unlimited credit line pretty much with hard money lenders. I would really hesitate in saying that there's any problem with paying discount points or paying 10 or 12% interest, because what you're doing is getting access to capital without the banks. And the banks have become a nightmare to deal with because of the Dodd-Frank and their regulations. So building relationships with hard money lenders is one of the most powerful things you can do with the right ones, not the wrong ones.
That's the first time that I ever heard that strip clubs have some crazy cash flow.
I mean, you think it's a cash business. And the funny part is I had somebody that pitched me on one and wanted to borrow about $250,000. And I said, why do you need $250,000? You already own the property. You own a strip club. You want to buy another one. Why do you need $250,000? And I think my guess is that there was probably a drug problem. There was probably a big lifestyle. And I just said, no, thanks. Not even if the deal made sense, I wouldn't want to do it. But it's a goofy industry. And I tend to stay away from goofy industries.
A lot of people look at 10 to 12% interest and they think that's crazy. Who would pay that much? But if you've got a deal where you're going to exceed that in return, and you've got a great degree of certainty of that, You can go ahead and potentially arbitrage that. But Damien, I want to ask you, with hard money lending, if someone is interested in originating a loan and being a borrower with the hard money lender, what are some of those signs where you would identify who's predatory? What are some of those danger signals?
You really want to understand somebody's experience in lending. So if you're going to go talk to a hard money lender, it's really important, if you don't actually know that person, to get some references of people that have been working with them for a number of years, that have done a number of deals, not just their friend, but somebody truly that has been through the ringer and has gone full cycle on a deal.
Yeah, Damien. So just kind of overall, you've had quite the ride in real estate investing. You've kind of come up with your rules for real estate investing. What are some of those?
The first thing is, I really don't invest with somebody that's doing their first deal. I'm really careful about where I'm going to invest. It has to be within a certain distance to me. So for me, I want to be able to fly somewhere and get back in the same day if I'm going to do something elsewhere, because I'm not going to invest in Myanmar in the middle of Asia. It's just not interesting to me. I'm careful about where I go, who I'm going to be with. There's something called position sizing, and there's a great book by a guy named Van Tharp. And he's probably the smartest traders coach in the world. So he's done a lot of work with stock traders. And he talks about position sizing and how much risk you're going to have on any particular deal. I see a lot of people doing deals where they have basically all their money and they say, I'm going to focus on it. And this is the whole anti-diversification. I'm going to do everything, all my money in one deal. I don't have any more exposure than 10 to 15% in any one deal ever. So it doesn't matter what happens with a borrower or a market. If something crashes, we were talking about Alaska and oil earlier before the show, and I'm going to be careful and sensitive to a lot of the disruptive technologies that are happening and a lot of things that are changing everything that we know to be certain, like oil. If oil goes away, there are certain places like Texas and Alaska that are going to change economically in a big way. So I'm careful about not exposing my entire net worth to an area that may have something happen that I have no control over. So I'm really, really sensitive to that. I was willing to basically put all my money into every project. And then a big one that a lot of people don't realize, when you sign on debt, you should be treating that exposure the same as you do cash. And what I mean by that is, if you've got a house you're buying and you have $10,000 in cash and you put that in there and then you sign personally on a $90,000 loan, you are literally investing and exposed to $100,000. And you should consider that when you're thinking about how much of your portfolio is being exposed on any one deal. I didn't think that was really important, because I thought, oh, how bad could a property go? I mean, if it's worth $100,000, could it drop to 70? What's my exposure? No, I mean, those things can go to zero. I mean, they literally can go. That is the potential. And if we don't acknowledge that, you're really setting yourself up for one-time event that blows you apart. So being conscious to the credit liability and making that equal to the exposure you have in terms of cash is an important thing for everybody to realize as soon as possible, and not like 10 years after you started, because you realize you're way, way overexposed with all the different risks you have in different places with equity and debt.
Well, you're the world's most unemployable man. I take that to mean is you're a man that could not work for somebody else. And I began the show by calling you a financial transformation expert. So tell us about what you do over there where you run Total Control Financial.
Total Control Financial is an empowerment and education company. Here's what we're doing. We're giving people a lot of tools to tap into their quote unquote retirement money. And this is a whole other thing. I hate the word retirement because I think it really means that we're done contributing, which means we're probably done living. And there's a reason that people die 3 years after they retire, typically in the United States, because we stop engaging. But let's just talk about this money that people have. It's all this money that they build up. It's usually their chunk of cash. In addition to their house, this is where they hold their money, their 401ks or their IRAs. What we're doing here is we're giving people some ideas and ability to take that money and move it away from the Wall Street space and put it into their hands so that they can go and invest and really start doing things that they control, things like single family houses, apartments, hard money lending. It's giving them checkbook control of both their ability to invest in things that they understand and things that they can control. And it's flexibility without the fees. I think a lot of people they're investing in things that they're told they should invest in because it's easy, and they're told basically that they're too stupid to invest. And the thing that I like about folks that are listening to your show is they're spending the time and investing in their future by engaging. They're not just saying, okay, here, take my money and I hope it works out and I'm going to smoke a bunch of hopium and that's going to be my strategy. That's not what people are doing. They're willing to take ownership and responsibility. That's what we do. We teach people how to invest and how to take control of their money and get it out of the Wall Street brokerage hands and into their hands so they can start being the lenders. They can start being the bank. They can be the investor. And then ultimately, when people do that, they realize, hey, you know what? I could share this with other people. And then you start building these really cool communities where, so-and-so's brother-in-law has a 401k, doesn't like Wall Street. and then they go, hey, you know what? We can do these deals together and we've got access to all this cash. It creates a lot of resources that are literally in people's front yards that they didn't even realize they'd existed. And now they've got control and they've got the ability to design their future and build the confidence by actively investing versus hoping that it'll all work out and really not having the ability to design anything and being subject to the markets doing whatever the markets are going to do. It's a life by design versus by default. And it's really empowering people to have true freedom and not be stuck on this crazy roller coaster that most people are stuck in.
So how does an investor get started? How do they act on that by directing their IRA or retirement funds into what they want to put them into?
The first thing that people do is they get educated on what this is. And really the first step is making an intelligent decision. So instead of saying, okay, here are the 5 steps that you do, that you set up this type of account here and you do this, I'm not going to tell somebody what they should do. I'm going to tell them what they can do. And I wrote a book about this called the Total Control Guide to the QRP. And people can get a copy of that at totalcontrolfinancial.com. If you go there and get a copy of that book, you're really going to start to understand this option, and empowering you with that knowledge and that information is the first step. And then you're going to decide whether this makes sense for you, but you've got to be educated. I think people that blindly go and do whatever somebody says and just say, yeah, I'm going to invest in that thing because so-and-so told me. If you don't know why you're investing in that thing or why you're transferring your money from Wall Street to your own account, you're setting yourself up. So you have to really understand why. And that's what this is. It's about educating you and empowering you with the right information.
A lot of people, most Americans, and even some listeners that are listening to us right now, Damien, they think that with the retirement funds, basically their only options are a limited suite of choices, all which kind of end up in stocks, bonds, mutual funds, or maybe ETFs. So when you learn more about investing and that inflation and emotion and taxes and fees typically take the returns from those vehicles down to zero or often even less than zero, you do want to empower yourself.
That's right. There's something that John Bogle says. He's the founder of Vanguard. Yeah. So if you've ever heard of Vanguard, the big investment company, mutual fund, really the S&P founder in a way, he says that there's something wrong with the system when 80% of the profits go to the brokers and the system, and they take 0% of the risk. So you as the investor are taking on all the risk, and you end up with 20% of the profits. This is his quote. It's on our website. And it really makes you think, how does this actually benefit me? It doesn't. The system is set up to benefit Wall Street. And it's even now, the rules changed recently to where you used to have to opt in to a 401k, but Wall Street actually had Congress change the rules so that if you go to a job and they offer a 401k, the automatic default is that you're opting in. You have to opt out. Right. So by default, your money's going to these brokerage houses and they're getting fees. You have to understand that the money is flowing their direction, not your direction. And so I think it's important for everybody to really understand where their money's going and who's in control of it.
Yeah, I really encourage listeners to go to Investopedia and search mutual fund fees, and your mouth will be agape by the time you're done reading that. So once you've read that and you've checked out Damien's report at Total Control Financial, you're going to be in a much better way toward empowering that dead money that you have in your retirement account.
That's right. That's the first step. When you're just taking that step and becoming aware, it's like taking a red pill. You've seen the Matrix. Once you take that pill, and it's a dangerous pill because once you take it, you can't go back. And I don't know anybody that really wants to have their head in the sand and not really have the power and control of being aware. You know, if you want to be aware, you got to take that pill and you got to go and find the truth. So I think it's a great suggestion to go and look that up and really understand how you're being robbed.
Well, this has been really enlightening, Damien. You've got such an interesting story and such a wealth of experience. Damien Lupo, thanks so much for coming on to Get Rich Education.
Thanks, Keith. It's been awesome. Real pleasure.
All right. Yeah. Well, thanks, Damien. I think Damien failed sooner than most people did, but he failed faster than most people did, and that's why he's now ultimately succeeding more than most people do. And I appreciate that he's willing to come on here and discuss his mistakes back in the Hungry Hippos days when he was buying sloppily without regard for accounting or cash flow.
Playing Hungry Hippo!
All right, that's enough of that. Jeez. It's good for you to buy a lot of income property quickly if fundamentals are in place, buying in a good market with a good team and cash flow from day one, and then you're set. Damien and I touched on equity harvesting there. I'll do cash out refinances and 1031 exchanges if it means that the repositioning makes my passive cash flow the same or greater in the new properties than the ones I relinquished or took cash out of. In fact, it's those exact techniques that were able to allow me to grow into more and larger apartment buildings with the addition of little or none of my own money as it grew Cash flow solves all problems. Now, I don't think that real estate values are going to go down substantially anytime soon in the stable markets like the ones that we invest in here in the Midwest and South. And why do I say this? Well, I think it's for a lot of reasons. Banks are still performing responsible lending. Rates of real estate appreciation are in line with historic norms, especially in the stable markets that we deal with. Although interest rates will go higher, the fact that housing demand exceeds supply in a lot of markets and the fact that our population keeps growing are going to keep things vibrant. And the fact that millennials want to rent, not buy, it's going to put us investors in the driver's seat for a while, and you can still lock in these interest rates when they're low. The way to act and find the right properties, providers, and markets is at greturnkey.com. Another thing to tell you is that a way for you to support this show by just performing the same actions that you would want to perform anyway is building your passive income real estate portfolio with the sponsors of the show here. This week, it's Graham Parham at Highlands Residential Mortgage and Marco Santorelli at Narada Real Estate. Graham and Marco like this show, so they've put their support into it. Likewise, you can support the show when you use Marco's or Graham's companies and let them know that you heard about them through Get Rich Education. That's kind of how it works. And these are the activities that you want to do anyway. Graham offers loans specifically for income property owners like you, and he provides that service in most of those states that have the best cash flowing markets. You can connect with Graham at texasinvestorloans.com, even though he operates in, like I've said, multiple states. And he does need to ask you for a lot of documentation as we are in a post-Hungry Hippos world. And Marco offers nationwide turnkey real estate, and Marco at Narada was actually one of the very first providers in the nation that's offered that service. I actually only know of one person in the entire nation that's offered nationwide turnkey real estate longer than him. Over there, you can go to naradarealestate.com. That's NORADA realestate.com. Click on the Properties tab, see individual investment property addresses, and connect with an investment counselor there. And only buy for cash flow. I could be doing more profitable things with my time than doing this show, but I love helping people. And thanks to Marco and Graham for helping offset some of the show costs. Consider showing your appreciation to them just the same. Don't buy just another property to have just another property, or you're playing Hungry Hippos. Buy it for the right reasons. I'll be back next week to help you build your wealth. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.